I'm gonna build a simple rules-based trading strategy for you. Then I'm gonna give you a 6-question trading quiz using real chart examples. My intentions is to try and trick you at least once. Let's learn to trade. What's the difference between a profitable trader and someone who gives back months of hard-earned profits in a single week? Now, you might think it's market conditions, you might think it's your trading strategy. But what if I told you the answer is actually much simpler than that? And today, I'm gonna have you take a quiz that proves that fact. Now, the other day, I received a message from a trader asking one of the most common psychological questions that I always get asked in the market. He had already found a strategy that worked. He had been profitable for 5 straight months, but one bad month completely knocked him off course. And he ended up giving back most of his profits by making what he knew was horrible trading decisions. I'll explain to you the solution I gave him in just a minute, but here's the short version. And this may seem weird, but I told him to stop focusing on making money and start focusing on taking good trades. Now, I know many of you guys have heard me say that before, but I also know that many of you guys don't know what a good trade actually means. So by the end of this video, I'm gonna make that crystal clear for you. And here's how. I'm gonna build a simple rules-based trading strategy for you. Then I'm gonna give you a 6-question trading quiz using real chart examples. Your job is simple. Decide whether each trade that I show you is a good trade or a bad trade. And I guarantee it, at least one of them is going to trick you. So back to that message I told you about. Here is what he said. He said, "Hi, sir. I appreciate you guiding me through this problem. I found my edge and my strategy works fine. The main problem is psychology. I know what is wrong and I know what is right. But in hard times, I still choose the wrong one. I don't know what to do. If only I could control myself from doing that. For example, I was profitable for 5 months, but just that 1 month didn't work for me and I lost control." Now, let me ask you this. Have you ever experienced something similar? Maybe not to the degree of 5 months and blowing it all in one, but maybe 5 days or 5 trades. Most of you have probably answered yes. And trust me, you're not alone. Yours truly is in that category. Again, this is one of the most common psychological questions that I get asked. And although fixing it isn't easy, there is a solution. And that solution is changing what you measure yourself against. You see, most traders are what we call outcome-based, and they judge themselves by questions like this. Did I make money today? Did I have a winning week? Was this trade profitable? And these would be good questions in any other profession. But the problem is, trading doesn't work like every other profession. In school, if you get the answers to the question right, you usually get a good grade. In math, 1 + 1 equals 2. In sports, the better team usually wins. But trading is different. You can do absolutely everything right, follow every rule, manage your risk perfectly, and still lose money. At the same time, you could do everything completely wrong. You can take a terrible trade, you can break every rule, and somehow still manage to make money. Yes, the markets are a weird type of wacko world. So judging yourself off the outcome doesn't actually tell you whether you're improving as a trader, and these short-term results can be completely random. You see, every trade belongs in one of 4 categories. There are good trades, there are bad trades, there are winning trades, and there are losing trades. But most traders think there's only 2. They think that winning trades are good trades and that losing trades are bad trades. But that's simply not true. You see, a winning trade can still be a terrible trade, and a losing trade can still be executed perfectly. And that's why focusing on your trading outcomes cause so many psychological problems. So instead of thinking about it like that, think about trading as being similar to a casino. A casino doesn't win every hand at blackjack. It doesn't win every single spin at the roulette table. It doesn't care about any single outcome. Why? Because it has an edge. As long as enough people continue playing their games, then eventually the probabilities, which are in the casino's favor, will work themselves out. And trading works exactly the same way. If your strategy truly has a positive expectancy, which is a statistical advantage, then your job isn't to make every trade a winner. Your job is to simply execute your edge consistently, because over enough trades, that's what will produce you profits. And this is why I always tell traders to focus on the process and focus on taking good trades. And again, a good trade isn't one that makes money. A good trade is one where you follow the rules of your trading plan 100%, exactly as written. Whether it wins, whether it loses, that doesn't matter. Did you follow the process? And if the answer is yes, then good trade. And that's what you should celebrate. That's what you should judge yourself on. Because again, if you can consistently execute your strategy, the profits will take care of themselves. All right, quiz time.
I want to play a game.
No, not that type of game. In this game, I'm going to show you 6 different trading opportunities. And with the information I just gave you, I want you to answer one question. Is it a good trade or is it a bad trade? I want you to keep track of your score. And when we're done, let me know in the comment section below how you did, because I am very curious to see how everyone does. And again, my intentions is to try and trick you at least once. But before we jump into the charts, we need to build a strategy. Now, let me make this very clear. I am building this strategy for this video's purpose. This isn't a real strategy that you should take, fund an account, and start trading live with. No. That would be a horrible idea. These are simply for the purposes of me showing you examples and for you being able to judge, did I follow my rules or not? And you may be asking, Akil, did you really have to say that? And my answer is yes, because there's always a few of you and you know exactly who you are. So remember, the purpose of this strategy is to simply demonstrate what a rules-based trading plan looks like, because once your rules are objective, it becomes incredibly easy to determine whether a trade is good or bad. Now, in order to make this strategy as simple as possible to follow, I'm going to build it using 3 indicators and my favorite price action entry technique. All right, so the first indicator we're going to load up is going to be our Bollinger Bands. And if you're unfamiliar with Bollinger Bands, they are a volatility indicator. They consist of a moving average in the middle, which is blue, and then 2 bands on the outside. You can see an upper band that is red and a lower band that is green, which represent a certain standard deviation from the moving average. And for you guys that are nerdy and like statistics, you know that the math says that on average, it shouldn't exceed a certain standard deviation for a set period of time. For you guys that are kind of simple-minded like myself, pretty much that means that these bands represent like a rubber band, and a rubber band can be stretched to a certain point, but it also must return to the middle before stretching again. So you can think about it like this. As price hits one of the outside bands, it is much more likely to return back to the middle than it is to stay and hang out outside of those bands forever. Next, we're going to use my favorite indicator, one that I've used for over 15 years in the market. And that is going to be the RSI, the Relative Strength Index. Now, the RSI is a momentum indicator. It measures the speed and the change of price movements in the market. Now, I can probably make a 3-hour training series on different ways to use the RSI, which reminds me, I do have a video coming out for you guys soon looking at a very unique way to use the RSI for entries, a way that you've probably never considered. So be on the lookout for that. But for today's purposes, we're going to keep things simple and we're going to focus on both overbought and oversold conditions. And I'll explain exactly what that means. If we take a look at my RSI, I have a few bands, which I'll make clear in a second, but we have an upper band right here that is going to be overbought. We have a lower band right here that is going to be oversold. When the market goes beyond, or when the RSI, goes beyond that lower band, it is in an oversold condition. When it goes above that upper band, it is in an overbought condition. Now, I told you I'm a big fan of the RSI, so I am going to make a few changes here. One, I'm going to change the length to 7. That's going to give me a quicker and more reactive RSI. 2, I don't know why I exited out. I'm going to make the band black just because it looks better for my eyes. I'm going to remove the EMA. I'm going to take the upper band and change it from an extreme of 70 and make it an extreme of 80. So I'm looking for extremely overbought conditions here. Let's make that red. And then I'm going to do the same thing for the lower band. I'm going to take that 30 and bring it down to 20 because I want to look for extreme oversold conditions. And we're going to make that green. So a little bit of a custom setting. I always tell traders this. The default settings for your indicator probably aren't the best settings that you should be using. You ultimately want to adjust it to whatever you want it to confirm on the price chart. For me, these are just my personal favorite settings with the RSI. So I always feel comfortable, even in a setting like this, kind of going back and using it that way. Finally, we're going to add one more indicator. It is going to be the ATR. That stands for average true range. Now, the ATR is another volatility indicator, but unlike the Bollinger Bands, it measures how much the market typically moves over a given period. Hence the name, average true range. And once again, because this is one that I use on a regular basis, I'm just going to get some confluence and make the ATR setting a 7 to give me more of a quicker and more reactive look versus the default 14. I'm also going to hide the ATR, banish it to the very bottom of my chart because I don't actually need to see the indicator. I just need the number for my profit targets. So now that we have our tools, let's build some trading rules. Step 1, price must touch one of the Bollinger Bands. Step 2, RSI must either be overbought or oversold. Step 3, price must form a higher high and higher close candle or lower low and lower low candle, depending on the direction of the trade. Step 4, stops must be placed 10 pips below the extreme of the 2 candle entry formation. And step 5, targets will go 2 times the ATR from my entry price. Now, to review it one more time and to make things even clearer, we're going to redo it in the same way that we teach our traders to write the rules of engagement section of their trading plan. And that is by using something called the if-then syntax, which essentially makes it look like a flow chart and makes it as hard as possible for someone not to follow. So if you break your rules, you really have to purposely be trying to break your rules. So here we go. If a candle touches the Bollinger Band, then look for the RSI to go overbought or oversold. If the RSI goes overbought or oversold, then look for a higher high and higher close candlestick or a lower low and lower close candlestick, depending on the direction of the trade. If we get a higher high, higher close or a lower low, lower close, then enter the trade at market on the opening of the very next candle. Stops go 10 pips beyond the extreme of the 2 candlestick formation. Targets are placed to ATR from your entry price, and risk reward wise, this trade must have a minimum of a 1-to-1 risk reward ratio. Now, make sure you remember these rules because I'm not going to remind you of them once we start the quiz. So if you need to go back, if you need to rewatch, if you need to write them down, do that now because now it's quiz time.
Let the game begin.
So let's start with question number 1. You can see price action comes down into our lower Bollinger Band. Our RSI down here goes oversold. We have a nice little pin bar right here. And our next candle, you can see, let's zoom in, gives us a higher close above the close of our previous candle. So let's mark this in. Our entry would be right here at the opening of the next bar. Stops are going to go 10 pips below this pin bar down here. So the low of our pin bar is 116.45. So that's going to put our stop loss at, let me just use this tool. This is a lot easier. Our stop loss at 35, right? Did I say 45, right? 35 right here. And then our ATR of this green candle, if you look in the bottom right hand of my screen, is going to be 26. 26 times 2 is 56. So let's move this thing up by 56 pips. That's about right. And then let's ensure that we have a 1-to-1 risk reward. Indeed we do. And let's see how this trade plays out. Price action pushes up, pushes up, pushes up. Come on. And boom, target achieved. Now, the question that I have for you guys, and I'll give you guys a little 5-second countdown before I give you guys the answer. Good trade or bad trade? All right, so although this was a winning trade, this would actually be a bad trade. And this is a little bit of a tricky one because it depends on your knowledge of candlestick formations, but I'll tell you why. Everything was right. The entry was good as far as our qualifiers. The Bollinger Band was hit. The RSI did go oversold here. We did our stop loss correctly. We did our targets correctly. The problem was our entry candle right here. So what we require for an entry is a higher high, higher close. And what that means is that this green candle must both break and close above the high of the previous candle. And if I zoom all the way in on this red candle, you'll see that the high of this candle is at 116.72. The close of this green candle is at 116.71. And I know what you're saying, Akil, it's only 1 pip, but this is a black or white rule. It is objective. And technically, we did not break and close above the high of the previous candle, making it a bad entry and therefore making this a bad trade. Real quick, if some of these concepts are new to you and you want to learn how to apply them in the right way, check us out at tier1trading.com. We were featured in Forex magazine as being one of the leading innovators in trading education because we don't just hand you courses and send you on your way. We work with our members every single day through live coaching, structured education, and an active trading community. So if you're looking for coaches, courses, and a community to help accelerate your trading journey, head over to www.tier1trading.com. All right. Question number 2. Price action comes up to our upper Bollinger Band this time. We can see that our RSI is indeed overbought. You can see above this red line right here. And then we have our lower low, lower close candles. Let's measure this out once again and get some stop losses on here. Our entry is going to look something like this, a short position, next bar market. So right at the opening of our next bar. Our stop loss is going to go 10 pips above the high of this candle right here. So again, let me kind of see what this candle is. Oops, sorry about that. Our candle here, our high is 116.27. So our stop loss is going to go at 116.37 right there. Our ATR of that same green candle right here is going to be 33. So our target is going to go 66 pips away from our opening price, which is going to be right here. Risk reward, much better than 1-to-1. Let's see how this plays out. Let's just kind of go ahead. Price action goes down and boom! 3 candles later, we have a winning trade. But we know a winning trade isn't necessarily a good trade. So now I have a question for you. Is this a good trade or a bad trade? I'll give you 5 seconds once again to give me an answer. If you said good trade, you are correct. We had everything we needed. We had all of the entry requirements. We did the risk. We did the targets all correctly. Boom. Good trade. All right, example number 3. And again, make sure you guys are keeping track of your score and also make sure you're keeping track of which ones you got wrong. Be sure to write that below in the comment section. That way I can have a better idea of what areas you guys are struggling on. But we have a test again of our lower Bollinger Band. Very nice long-tailed doji. We have the RSI, massively oversold. We have a nice entry candle right there. Higher high, higher close. Let's get on our risk reward profile. Let's see, our low right here is 115.30. So stops are going to go down at 115.20s. I love it when the math is easy. Our ATR of our entry candle is 88 or is 44. So 44 times 2 is 88. So let's get this up at 88 right here. All right, so let's see how this plays out. Let's click forward. I love replay. It's a great tool for any of you guys who are learning how to trade. Price action goes up, price action goes up, price action goes up. What are we doing here? We're kind of going sideways, that devastating consolidation as we spoke about in the last video. Let's see, let's see, let's see. Oh, now here's an interesting thing, right? So we've come to the end of the week. This is a Friday, and I know you guys know about weekend gaps and everything like that. What I'm going to do here is I'm going to give myself a little bit of a safety cushion and just spread my stop out about 10 more pips. Let's go down to 115. Let's go to 115 even, or right below that psychological number. Psychological number is an even-handled number, any number that ends with a 0, 0. So those are numbers we typically want to avoid. So let's give ourselves some safety there, just in case we get any weird gaps in the market. Oh, look at that. We did get a gap in the market. There we go. Thank God we moved that stop. And then let's see. Come on. Oh, going up, going up, going up, going up, going up. And then right here, we got a nice little engulfing candle. So this is something called trade management, right? The trade started moving in our favor, right? After it violated our initial low. We got an engulfing candle right here, which is a bearish sign. So what I'm going to do is I'm just going to exit the trade right here, save myself from any unnecessary loss, and call it a day. So ends up being pretty much a scratch trade. I think it loses maybe a couple of pips, but anything's better than losing that big amount. All right. Enough of me rambling. Good trade or bad trade? If you said good trade, you are wrong. This is a bad trade, and it's a bad trade on many different reasons. Let's start with the first one. Initially, right, we had a stop loss right up here at 115.20. If you guys remember our rule for stop losses, it had to be a minimum of 1-to-1. You can see that it is just slightly below a minimum of 1-to-1. So that would have been a big red flag right there and a reason to never get in the trade in the first place. Number two, I moved my stop loss back. Now, although I justified it with the fear of a weekend gap, and I'm not saying that is a good or a bad rule, but the point is, it wasn't in the rules that we laid out for this specific trade. And anything that we do that deviates from our trading plan is a bad rule. So that's strike number two. The third one is early target taking or early profit taking. My profit targets were all the way up here. Now, again, I justified it by the fear of almost being stopped out and the engulfing candle giving us a bearish sign. And that was all I needed to tell myself, hey, Akil, this is a trade management technique where losing 0 or a little bit is better than losing a lot. And again, there's nothing wrong. This is actually a technique called the graceful exit that we teach many of our traders over at Tier 1 Trading. But it wasn't in the rules. So this is also a bad trade. So a bad trade on many different planes, this one. I hope you guys got this right. I hope you at least got one of them. This should be a no-brainer for everyone. All right, trade number 4, and you guys should be used to the rules by now, hopefully, but you can see this time, once again, price comes to our top Bollinger Band. We have a clear lower low, lower close entry right here. So let's get these targets on. Our entry is going to be at the close of this red candle. Our stops, as always, 10 pips above the high. So the high of our 2 candlestick formation is 117.55. So that's going to put us at 65, right around there. Our ATR of our entry candle is 22. So that's a 44 pip target. Get down there. There we go. 44 pips. Risk reward more than 1-to-1. Let's see if this goes on to win. Winner, winner, chicken dinner, money in the bank. However, was it a good trade? What do you guys think? If you said no, you are correct. This was another bad trade. Almost everything was right in this situation except for one thing. Our first requirement is that the Bollinger Band is touched. Our second requirement is that the RSI goes overbought. And in this case, it did not. We came up to 75, which is our traditional overbought settings. But remember, we adjusted our settings to 80. We did not clear that red line. Everything else was good. The entry was good. The profit potential was good. The risk reward was good, but we did not meet the rules. So, bad trade. Time for trade 5, and I hope you guys are doing good. Another bearish opportunity here. Price action comes up to our upper Bollinger Band. RSI is overbought. We have our lower low, lower close candles. Let's get our entries and whatnot on. Highs of our highest candle right here is going to be 107.76. That's going to put us up at 107.86 for the stop loss, which is right there. Our ATR is 23, so times that by 2, that's going to be 46. Let's move this down to 46. There we go, right there. Risk reward looks good, so let's see if this thing gives us a win. We come down, we go sideways, we're almost there. Not going to take profits early this time, I promise. Yep, and it ends up being a loser. So, question for you. It did lose, it lost us money, but was it a good trade or a bad trade? If you said good trade, you were right. Yes, this trade was a loser, but if you look back, we followed every single one of our rules. Our Bollinger Band was hit. Our RSI was overbought. Our entry candle was a lower low, lower close. Our targets, or our stops, were in the right place and we did not move them. Our targets were in the right place, and although price didn't get there, we did not move them. This is just called a losing trade. And the fact of the matter is, this may come to a surprise for many of you, contrary to popular belief, and by popular belief, I mean social media stuff, most traders don't win at a really high percentage, right? You hear everyone bragging about, I'm a 95% trader, a 90% trader, an 80% trader, an 85% trader. The honest truth is most traders range anywhere between like 40 and maybe 70%. The thing is, when we have the edge, meaning that we have that probability of winning versus losing, when we have a risk reward that is consistently in our favor, well, you can just do the math and you can see that you can easily be a profitable trader even if you're winning 40%, certainly if you're winning 70%. So understand that losses are just a part of the business. And if you ever did any back testing, you'll see exactly how much you lost, but still made profit in the long run. One more question to go. All right, last one. I want everyone to get this right, so pay close attention. Price action comes down to the bottom Bollinger Band. RSI is oversold. We have a higher high, higher close candle. This is a long opportunity, so let's get the right tool on here. Stop loss is going to be 10 pips below the low of the candle. Now, the low of this two-range candle, in this case, the entry candle actually has the lowest point. So we're going to choose the low of this candle instead of the previous one. So the low of this entry candle is 113.24. So 14s is going to be our stop loss right there, nice and tight. Our ATR is 25. Ooh, easy math once again. So let's make that 50. There we go. Nice little risk reward. But I'll tell you what, if you look left, right, you always know what I say, look left, structure leaves clues. We actually have a nice level of structure a little bit above that. So let's just stretch this out just a tad bit more. Let me just see something real quick here. Sorry, I'm getting nerdy. Yeah, let's just stretch it out a tad bit more and get a little bit more bang for our buck here. So let's see what this does. Price action goes up, goes up, goes up, goes up, goes up. Actually, I think I can, well, no, we'll keep it there. Goes up, boom. I was going to say, I thought this can go a little bit higher up to this level as well, but let me see here. Nope. Glad we kept it there. All right, that was, no, it did hit it. Good decision. Anyway, winner, chicken dinner to end things off. But the question is, good trade or bad trade? If you said bad trade, you were correct. Now, this is interesting because this would have been a good trade. The entry was correct. Price action came down to the Bollinger Band. The RSI was oversold. The higher high, higher close. The stops were placed correctly. The targets initially were placed correctly, but then I decided to adjust them higher. And here's the interesting thing. You're saying, Akil, well, you adjusted them higher based on structure. I know you're a structure trader, and it worked out. It made more money. Yeah, it did. But remember how we grade ourselves. It's not about winning or losing. It's, did we follow the rules 100% or did we not follow the rules 100%? And even though this was a trade and the mistake that I made it an even more positive trade, it has to be considered a bad trade because I did not follow the rules. And why this is dangerous is because in the future, when we feel like we have the freedom to deviate from the rules and we do things like shooting for more, yeah, it worked well during this opportunity, but what about the opportunities when you adjust it and then price action turns around right before you and you end up losing, only to say, man, if I would have kept them where they were supposed to be, I would have won. That's what we want to avoid. Now remember, leave your score below. Tell me which ones you got wrong. And if you're interested in learning more about indicators, check out this video on the most popular trading indicators ranked by real traders. Bye-bye.